Welcome to Market Call. I'm Morella Fernandez. Brian Madden with us on the show today. He is Chief Investment Officer at First Avenue Investment Counsel. He'll take your questions on North American equities. Here's how to reach us. Call toll free 1-855-326-6266. You can email your questions as well. marketcall@bnnbloomberg.ca. Brian, thanks for coming in today.
Pleasure. Thanks for having me.
Most of the markets seem to be down today, at least a little bit, but we had another record close yesterday for the TSX. The NASDAQ 100 finally pushed through a higher top there. How would you describe what's going on?
Yeah, I mean, I think what we've got is the classic markets climbing a wall of worries. There's no shortage of things to worry about. We had rocket fire in the Middle East over the weekend, and we have suspension but not cancellation of tariffs. We have a budget bill trying to snake its way through the House and the Senate. But nevertheless, the market trudges higher, buoyed with some support from corporate earnings and mostly by improving sentiment. Just to say, that's really the inverse of waning fears and panic as we saw in April. And so it's the market doing what it does. Shareholders own the profits in the economy, and the economy grows inexorably over time. So, markets make higher highs, punctuated sometimes by short, sharp drawdowns that do test the mettle of investors.
Some are saying or suggesting that investors are now taking a bit of a breather after the first panic of trying to deal with tariffs and then recover from that. And now perhaps they're just tired.
Yeah, I think certainly there was a lot of frenetic trading activity early in the second quarter and late in the first quarter. And, so that accrues to the benefit of some businesses like owners and operators of stock exchanges, investment banks, and brokerages. But you're right, it does sort of wear out investors, especially when you keep getting head fakes and knee jerks that are, frequently misinformation. So I think, investors would do well to learn a lesson, which would be focus on the fundamentals, focus on owning good businesses. Don't bury your head in the sand as to geopolitics, but don't be ruled by it because the shifting sands shift often, and you can easily misread them. It's a lot easier to build robust and resilient portfolios that will weather geopolitical and macro headwinds and tailwinds, come what may.
It almost seemed like there wasn't a big reaction to the Iran-Israel conflict, and there was concern, but definitely not panic on the markets.
No, and I think, what really took some of the fear premium out of some of the classic tells when you have hostilities in that region of the world was oil prices, had probably by some accounts and estimates $10 to $15 of sort of geopolitical risk premium baked into them going into last weekend. But then, the U.S. waded into the fray and dropped their bunker buster bombs, and who knows what the results of that really were. We're getting conflicting information, but I think the thing that sparked this latest multi-day relief rally we're seeing in equity markets, notably in the United States, is the very tepid, feeble, some might even say symbolic response by Iran to those strikes. Firing a small volley of rockets at Qatar and giving the U.S. a heads up, like a courtesy call. By the way, we're going to be lobbing some rockets over your wall. And so, of course, the U.S. easily shot them down. And really what that did was took the worst case scenario, we think, off the table. The worst case scenario, of course, being, a massive strike on some of the oil infrastructure in the region, or worse yet, attempts or success in closing the Straits of Hormuz, which, of course, as everybody is now well and abundantly aware, through which 20% of global oil supply transits every day. So that would have obviously been very negative for the global economy and risk assets. That didn't happen, and I think that's why we're seeing this relief rally over the last couple of days.
Just take a breath. All right. We are going to line up some phone calls and some emails for Brian Madden of First Avenue Investment Counsel. He's taking your questions on North American equities today. Here's how to reach us. Back in a moment. Welcome back to Market Call. Let's get to an email from Ryan. He says, hi, can I please get your thoughts on BN and if it is a good entry point? Is there a metric such as PE ratio or PB ratio that accurately conveys how expensive it is?
Great question. Thanks for that one, Ryan. So quickly, BN, of course, is Brookfield Corporation. That's the mothership of this huge constellation of Brookfield listed and unlisted affiliates. It's got probably the most complex org structure and accounting I think I've seen in any sector in any country I've invested in. And as such, it often confounds traditional ratio analysis when you're trying to gauge valuation. So you can look at things like price to earnings or price to book ratios. And if you were to do so, you'd find it trades at about 14 times earnings and 2.2 times book value. We don't particularly rely on those metrics, just given the complexity of the org structure and the oddities of the accounting and the nature of the business, which is such that they're frequently booking cash and non-cash gains on investments and acquisitions and divestitures. So, it's kind of a moving target. So, something that is more simplistic but more reliable and objective would be something like the dividend yield. It's cash in your pocket, and Brookfield has paid a dividend for a long time and has made a commitment to growing it. So right now, on that basis, these shares would be quite expensive. The dividend yield right now, is about 0.6%. And so putting that into historical context, over the last decade, the average dividend yield ratio has been about 1.5%. But even at that, you would still probably come to the wrong conclusion and say it's overvalued. And so I think when you look at things like this, whether it's PE or price to book or dividend yield, you want to understand whether there is a secular trend towards the business re-rating because it's getting better. And we think that is the case with Brookfield. And so the dividend yield gets lower and lower and lower every year, not because they're cutting the dividend, but just because investors are flocking to the stock more and more as it gets bigger and better. So we like it. We own it. We've owned it for a long time, added to it earlier this year. And we like it because it is a global leader in private market alternative investments. We, of course, eat our own cooking as well and are big fans of private market alternatives in our own business as well. Brookfield is an order of magnitude larger, of course, and is the leader in real estate and in infrastructure, in private equity and renewable energy, and just in the last 5 years or so has made big, bold moves into insurance markets and other wealth offerings, such that they're now managing over $1 trillion and are benefiting from a secular rebalancing of both institutional and private client portfolios away from just publicly traded stocks and bonds into alternative assets. Great management, shareholder alignment, great leadership and culture. And, we think they are a dominant player in this business and will continue to be for a long time. So, we continue to like and own the shares here.
Got it. Okay, let's go to the phone lines. John's on the line. He's calling from Milford today. Hi, John.
Good day, Brian. I would like your thoughts on TD Bank going forward. I've owned all the banks for well over 20 years. And do you think TD is out of problems now? Thank you very much. Bye.
We do like TD Bank, and we're quite pleased to see how the market has revalued it higher as we see light at the end of the tunnel after it was mired in this regulatory scandal for the better part of 2 years, but obviously reached a settlement with the U.S. authorities, agreed to paying a historic fine of about $3 billion US dollars, changed out most of their board and the CEO, and are trying to reset the growth algorithm. They've suspended their medium-term earnings growth aspirations and some of their other key performance indicators, with a view to resetting them at an upcoming September 29th Investor Day, which we will attend. This is just to give the new CEO time to sort of assess the situation and reset the strategy. But what we like here is a great Canadian personal and commercial banking franchise, a good and growing capital markets business, a good scale player in wealth and asset management. And one of the largest banks in the United States, notwithstanding that they were not able to complete that First Horizons acquisition due to the regulatory problems a couple of years ago, it's going to be challenging for them to grow the U.S. business. But we think they'll have a few creative strategies in mind. They're already talking about and acting on restructuring their balance sheet and offloading lower yielding assets and non-core, non-strategic parts of the business with a view to increasing the overall earnings power, even in the face of that consent decree asset cap. So we think there's enough levers for them to likely be able to engineer their way to a high single-digit earnings growth rate, and we'll be looking eagerly for more clarity on that heading into the late September Investor Day. So we like and continue to own the shares of TD.
Got it. Okay, let's go back to the phone lines. Elliot is on the line. He's calling from Hamilton, Ontario with a question. Hi, Elliot.
Good afternoon. Casey's General Store in the States seems to be under the radar. Unique offering, servicing, I guess, smaller communities right now in the heartland. The CEO indicates he sees a long, long runway for additional units. Please, your thoughts on CASY. Thank you.
Yeah, thanks very much for the question, Elliot. We don't own these shares. We own their larger rival, the Quebec-based Canadian convenience store giant Alimentation Couche-Tard. But certainly no quarrel with this business. It is really an exemplary convenience store operator with, as you said, a fairly niche footprint geographically, at least, certainly as compared with Alimentation Couche-Tard, largely in the U.S. Midwest. And these are markets that are lightly contested where, they may be the only convenience store in town, unlike in urban centers where there could be 2 or 3 of them in a mile.
If they grow, then are they expected to grow in larger cities where they would have more competition, or just grow in the same kind of communities they're in now?
I think the expectation is they'll continue to use the same playbook and expand in these lesser populated areas. The other thing that they do really well that 7-Eleven and Alimentation Couche-Tard, I think, would like to emulate is their food service offering is excellent. I mean, you wouldn't think of ordering a pizza from a convenience store, but they do, and they compete with the big, national pizza chains quite well on price, service, and quality. The other thing is, should Alimentation Couche-Tard be successful in acquiring 7-Eleven, which they're maneuvering to try and do, albeit with some resistance on the Japanese side, it's extremely likely that the Federal Trade Commission would require them for antitrust reasons to divest some thousands of 7-Eleven stores in the United States. Well, guess who is the likely odds-on buyer for some of those at, probably not fire sale prices, but probably compelling prices because it's sort of a forced sale, under threat of not approving a broader merger of Couche-Tard and 7-Eleven. So there's good optionality in Casey's General Stores, apart from generally running a pretty tight ship and a good business there.
Yeah, easy growth if that does happen for them. All right, we're going to take a quick break. We're back with more of your phone calls and your emails in just a moment. Welcome back. Thanks for joining us. We're going right to the phone lines. Harish is on the line with a question. He's calling from Guelph, Ontario. Hi, Harish.
Hello. Good afternoon. Thank you for taking my call. I have a question on U.S. Bank Corp. I had been following this talk and wanted to know your opinion. And along with that, there is another company, PepsiCo, which has been going down for the last 2 to 3 years. See what your take on it. Thank you so much.
Great. Thanks very much for the question, Harish. I'll confine my remarks to one of those 2 names, the one that I know better. And little teaser as it relates to U.S. Bancorp. I think we have a better idea, which I'll share at the end of the show in U.S. banking. But as it relates to Pepsi, of course, this is a company that needs no introduction. We ourselves owned it in our dividend growers mandate, sold it better part of a year ago. It had performed well from the time we put the position on in 2022. But then things started to get a little bit more difficult in 2024, and the valuation started looking a bit full. And so really it was facing the same sorts of problems that a lot of these consumer packaged goods companies faced early in 2024, late in 2023, after 3 years of really epic inflation. Initially, as the inflation came on at a speed and an intensity that most consumers can't even really remember, a speed we haven't seen in 11, we haven't seen since the 1970s and early 80s. What economists call elasticity was pretty low, which is to say the consumer packaged goods companies were increasing their prices to pass through the inflation in input costs and wages and so on. But the volume of demand didn't seem to go down that much. That is to say, consumers were pretty insensitive to the price increases, but the cumulative effect of the inflation started to catch up to them, and their sales volumes started to get very tepid. And so we sold the shares a little over a year ago, and we have not revisited it and are not particularly inclined to do so just as of yet. With the macro economy starting to soften and the inflation genie not really fully back in the bottle, at least not to enough to placate the Federal Reserve to lower interest rates and take their foot off the brake in the United States. So this is part of a cluster of other consumer packaged goods companies where we had positions and moved on, a year or so ago. For those same reasons.
Let's go to another phone call then. We have Heather on the line. She's also calling from Ontario. She's calling from Aurora. Hi, Heather. Heather, are you there? Okay, so let's move on, if we can, to Robert, who is calling from Toronto. Hi, Robert.
Yes, good afternoon. Thank you for taking my call. I am calling to ask about Alphabet. What is your thesis on this stock? I'm assuming you own it. Thank you. Have a good day.
Thanks for the question. We do, yeah. So this is a name that we own in our Momentum portfolio, managed by my colleague Ian Chong, and Ian has done some great research on this name. Obviously, most of us know Alphabet as the parent company of Google. Google, of course, is the dominant web search property and a leader in online and digital advertising. So that's a tremendously cash-generative business. In addition to that, they also own the G Suite of productivity tools. YouTube increasingly is a valuable advertising property. And what's really growing quite rapidly for them is their cloud services business. So they're one of the top 3 players in that space, along with Amazon and Microsoft, and are holding their share nicely there. Investing in artificial intelligence, doing some very innovative things there that we think will pay off nicely for shareholders, stakeholders broadly. And then, of course, there's a whole series of what they call other bets. I don't know if they still include Waymo in that portfolio of other bets anymore, or if it's large enough that it kind of merits its own spotlight. But that's going to be an interesting experiment and possibly cash generator as the technology and acceptance of it matures. So lots of reasons to like it and continue to own it as we have for a number of years now.
Would you go Amazon over Alphabet, or would you put a little in each at this point? Do you favor either?
We favor Alphabet, so we
favor
don't own Amazon, and we do own Alphabet. So that's how we see that pair.
Got it. Okay, let's move on to Anita, who's calling from Markham, Ontario. Hi, Anita.
Hi, good afternoon. Thank you for taking my call. My question is on CNR. I own both CNR and CP for a little while now, but I don't see the stock prices going up. So I just need your thoughts on it. Should I keep holding on to it, or should I move on? I'll hang up and listen to you. Thank you.
Okay, thank you for the question. So, CNR.
CNR, yeah. So we don't own this, Anita. We did own it in the past. We switched it in favor of a trucking company late last year. I think in all candor, we were probably a bit early in making that switch. They're both transportation companies, but one is sort of a more cyclical and higher torque way of getting exposure to a recovery in the goods side of the economy, the merchandise to manufacturing economy, which realistically has been in what transportation executives would refer to as a freight recession for the better part of the last 3 years. My colleagues and I attended a RBC Industrials conference just about a month ago, and the word freight recession was everywhere. So a recession is not always never one thing. It can be centered in tech, it can be centered in housing, consumable goods, or freight, as it is in this instance.
And they said about 3 years. Was there something that triggered it? Obviously, the last few months would have made sense, but 3 years.
Well, 3 years. So if you think about what it is, a recession is just really, a negative change at the margin. Yes. So if you have difficult comparisons, and if you think about what we were all doing during COVID, we were foregoing consumption in the service sector of the economy because it was closed, really, for all intents and purposes. And so what did we do? We all bought Pelotons and bread makers and gardening supplies, yes, and bicycles and jet skis and boats and so on and so forth. And so, the thing is, you don't need to replace these every year. So, a lot of demand got pulled forward. And so goods need to be shipped. And so with all that demand pulled forward, we've had difficult comparisons that the transportation sector has been struggling to recover from. But getting right to the meat of your question, do you want to continue owning both of these rails? Yeah, I think there's no good reason to abandon them. If you think about franchise and forever earnings power, that's what you've got. The rail sector is largely an oligopoly with 5 or 6 sort of large North American rails. And unless and until Jeff Bezos figures out a way of shipping a grain hopper from Manitoba to the Port of Vancouver with a drone, I think if we look in 100 years, that iron is still going to be in the ground and those trains are still going to be pulling freight over the rails to end markets. And CN is a veritable backbone of the Canadian economy. $250 billion worth of merchandise roll over those rails every year. That's about 8 or 9% of Canada's overall GDP, and we don't think that's going away anytime soon. And we think that's largely why CN has been a tremendous compounder and outperformer of the TSX Composite ever since it IPO'd back in 1995.
Got it. Okay, we are going to take another quick break. When we come back, we'll have a look at Brian's past picks. Stay tuned for that. Time now to take a look at Brian's past picks from June 21st of last year. At the time, you picked Bombardier, and it was at 89.56. It's gone up now to 114.89, so a 28% upside return. Same for total return. Do you still like Bombardier? I know they just recently took some new orders. They're doing well. Do you like them sort of longer term?
We do, Morella. This stock is gaining altitude, and we're pleased to see that, although not surprised. We bought this, I think, around May or so of last year, and really sort of did a deep dive on it and dusted off the file. This was a stock that was a serial destroyer of shareholder value for 20 years, from the turn of the century really until COVID, and then they basically yard sailed all the other businesses. They'd spun off the Sea-Doos and jet skis a long time ago, but got rid of the C-Series. Airbus owns that now, and the trains went to a European manufacturer. So it's now a focused pure play in private aviation. We think it has technological leadership in the medium and long range aircraft via their 2 airframes, those being the Global Express and the Challenger series of planes. Their order book is looking pretty robust. Their production slate is full, planning to produce about 160 planes a year. They round that out with some more stable and less discretionary revenue lines, notably in aftermarket parts and service. And also, there's some optionality here and another angle to the story, which is on these 2 airframes, they can be repurposed for military use cases. Okay. So they have in the past sold a limited number of these planes to NATO allies for command and control and reconnaissance and surveillance purposes in flight sorties. And so obviously with the NATO summit going on in Europe and Canada and the European allies, and of course the US committing to step up defense spending, and Canada having dramatically boosted their defense budget, and Prime Minister Carney making a commitment that some of these dollars are going to stay at home. There's only so many places it can go. We think some may find its way into Bombardier's hands. So this is not out of the woods yet because it's got a long and complex supply chain, and tariffs are still a wild card. But we think the fact that the stock has broken out to fresh all-time highs is a good testament to its resiliency, and the fact that the worst-case scenario for tariffs is probably not going to materialize. Got it.
Okay, let's get to your next past pick, Broadcom, which at the time was 1,658.63, now down to, sorry, I think that's the wrong number there.
I think we got an extra decimal point. It's 165, I think, is
thank you. I'm like, we've got a different number there. So it's 268, an upside of 61%, and a 63% upside return there. But also the stock split. Tell me about Broadcom.
So Broadcom, we bought, I think, just over a year ago. And I will say, Morella, I have great teammates, and some great research work was led on this name by my colleague Ethan Cummings. So this was the second sort of large semiconductor manufacturer that we introduced, or I should say the third. We had owned a couple others in our Momentum mandate, but this one we own in our dividend growers portfolio. It's somewhat unique in the semiconductor space in having a total return framework rather than just growth and stock price appreciation. Does pay a dividend and has increased it mightily over the last 8 or 9 years. And so what we like about it is there's a legacy business as a supplier to the PC manufacturing industry and cell phone handsets and other applications, some industrial, but increasingly this is a semiconductor manufacturer that is on the vanguard of supplying AI chips to the hyperscalers and others. And we think it got a fresh look when people realized what a tremendous performance NVIDIA had really turned on the afterburners ever since ChatGPT was deployed in late 2022. Broadcom had lagged, but it started to catch up and closed a bit of a valuation disparity that we had spotted at the outset. But we continue to like and own it here, and we see a long runway of growth in front of it and the other semiconductor suppliers to the AI industry.
Yeah, it was 146.29 during the depths of April, and it has now bounced above the high from earlier this year, so it's actually doing quite well. Let's quickly get to your third pick from last year, Lennox International. They do cooling and heating systems. At the time, it was $543 US, now up to $566.81, so 4% return and a 5% upside return. Are they an international company?
Well, it is largely a U.S. company, Merrill. There are some sales in Canada, but mostly the footprint is in the United States in terms of sales. There's a bit of manufacturing in Germany, and they recently opened a new manufacturing facility in Saltillo, Mexico. So this one, a little bit similar to Bombardier, is somewhat vulnerable to the shifting winds of tariff and trade policy, but we think they will be able to navigate that reasonably well. It's got technological superiority in these HVAC systems. It's secularly advantaged by climate change. There's not too many companies that you could say legitimately are advantaged outright by climate change. Most of them have some vulnerabilities. But the reality is, and we know this very well here in Toronto with the mercury busting 44 degrees yesterday, it's still quite hot today, that increasingly big parts of the United States and Canada are uncomfortably hot for longer, and so we just need more and larger, cooling units. And in the winter, there's heat pumps and other innovations that they've deployed. Some of it is their own intellectual property. Some of it is in joint venture with Asian partners, but they've got good go-to-market capability with a good distribution network, both owned and third-party. And a good record of growing their earnings and dividends, which we think will persist for a long time. So this one, although this one's lagged the other two, we do think there's more in the tank here, and particularly as we get into the back half of the year, and likely and hopefully we see some of this tariff and policy uncertainty lifting.
Okay, we do have to take a quick break. We're going to be back with more of your phone calls in just a moment. Welcome back. Back to the phone lines. Ross has been holding on the line from Windsor, Ontario. Hi, Ross.
Hi, thanks for taking the call. Great show, Morella. I'd like Brian's opinion on Waste Connections. Hit a high a couple months ago, but ever since then it's sort of been in the dumpster a little bit. So I'd like his opinion.
No pun intended. Okay, so let's have a look at Waste Connections right now. They are at 186.15 is what I have. Generally, do you guys invest in this kind of thing, in waste disposal, anything like that?
We do. So we don't own Waste Connections. We did own it 3 years ago. We switched this one for Waste Management, which is bigger and in our view better. But really no quarrel with this one. Their strategy is a little bit different than Waste Management, which, by the way, just hosted their investor day yesterday. My colleague Ian and I sort of tuned in for part of that and got some good takeaways. Waste Connections, I would say, is different, owns fewer landfills, but is advantaged by mostly operating in geographies that are lightly contested, where they're sort of the sole supplier, so that's advantageous. But the basic growth algorithm is the same across the industry. Low single-digit volume growth, pricing a couple points above inflation, some operating leverage, and a little bit of tuck-in mergers and acquisitions, and it all rolls up to a high single-digit or low double-digit earnings and dividend growth rate. So if you own this one, I think there's no reason, to sell it, but our preference would be for Waste Management here.
Got it. Okay, let's go back to the phone lines. Mario is on the line with a question from Toronto. Hi, Mario.
Yes, hi. I think I'll change my question from Alimentation Couche-Tard to Nestle.
Okay, so you're looking to buy Nestle, or you have Nestle?
No, I have Nestle, and doesn't do so great. And I will have another question, if I may, about laboratories.
Okay, we can only keep it to one because we are stacking up in the callers here. So let's talk about Nestle.
We don't own Nestle, and I'd be remiss if I were to lead you astray and pretend to know it while I don't. Our firm has a mandate to invest primarily in Canadian and U.S. equities, in addition to some of the private markets and other asset classes, but not in European equities. So unfortunately, I cannot be of much help to you in terms of an opinion on Nestle. My apologies.
Let's move on then to Bob, who's calling from Toronto as well. Hi, Bob.
Yeah, hi, Morella. And hi, Brian. Brian, I'm wondering what your thoughts are on Nutrien. I think it was one of your past picks last time, or the time before that, and I'm just wondering what your thoughts are. Thank you very much.
Okay, thanks for the question. Nutrien started climbing up sort of the start of this year, but it's been a little volatile.
Yeah, it's been bumpy. They're sort of right in the thick of it now. The second quarter is a crucial selling season for them, but we like this. We had owned it in 2022, but the fertilizer cycle peaked and we moved on, but we reintroduced it to portfolios in January after meeting with the management team in the fall last year. Long story short, we think the fertilizer cycle has bottomed and is slowly turning up. Reminder, this is the company that is the largest producer of potash in North America, also produces nitrogen fertilizers and mines phosphates, and is vertically integrated with a downstream farm supply store. I think about 2,000 retail farm supply stores, mostly in Canada and the United States, and to a lesser extent in South America. They're doing a bit of operational improvement in South America to improve the margins there. And the North American business is an excellent one. But the crucial swing factor for their earnings is going to be the supply-demand dynamics in potash. And supply has been a bit troubled, with some mines experiencing difficulty in other parts of the world. And so we think the potash price cycle has bottomed. As a reminder to viewers, potash briefly got over $1,000 a ton in 2022, troughed at about $250 a ton last summer. It's now about $330, $340. The Indian and the Chinese contracts we're hearing are settling somewhere around $340, which usually sets the global floor price on potash. And that should allow them to earn well and reboot their earnings growth from cyclical trough levels. So we think there's a lot of upside here, especially with the shares trading at roughly half their peak value of 3 years ago.
Okay, the shares are at 81.29 today. Let's quickly get to Rob for our last question in this block. Hi, Rob. What's your question?
Hi there. Thanks for taking my call. I'd like Brian's opinion on the big 6 Canadian banks. and if he thinks they'll be facing any potential headwinds with what's going on in the housing market and the Canadian economy.
Okay,
Thanks.
thank you for the question. So without getting into each bank, I think generally as a sector, looking forward, people are worried about the weakness in the economy and how some of the banks will do through that.
Yeah, great question, Rob. We own 3 of the Canadian banks in our dividend growers mandate. We've owned them for a long time. And really, we think the Canadian banks are a cornerstone of a growth and income portfolio in Canada. They're secular outperformers of the TSX. And the basic growth algorithm is they aspire to grow their earnings and by extension their dividends at usually 6, 7, 8% per year. Typically, you get a 3.5 to 5.5% dividend yield on the shares. You put those two together, and you've got a good line of sight over a cycle to a low double-digit total shareholder return. We think that's sustainable, given that it's effectively an oligopoly with 6 banks controlling about 90% of the market share. It's well-governed, well-managed, well-regulated, and stable, and diversified across lines of businesses. It's not just deposit and lending, but wealth and capital markets and insurance and other things. So we think the banks will, pull all sorts of levers to overcome macroeconomic headwinds, and we think they will sort of manage their way through to roughly on algorithm, which is to say high single-digit pace of earnings growth this year, notwithstanding the sluggish housing market.
Got it. Okay, we do have to leave this part of the conversation. We're back with more phone calls and emails for Brian. We're back in a moment. Welcome back. Phoebe is on the line from Toronto with her question today. Hi, Phoebe.
Hi there. Good afternoon. I was wondering if I could get Brian's insight on Rogers Communication. Their price seems to be low, and they seem to be making interesting deals, particularly with Blackstone. I'm thinking about the next 3 to 5 year range.
Okay, thank you for the question. Let's have a look at Rogers. Generally, we've spoken in the past about telecommunications companies struggling. All of them have been trying to do different things to change it up a bit. What's your take on Rogers?
Yeah, so maybe the tide is turning in terms of the competitive intensity in the telecom sector. We think there's sort of stirrings of that, although it's not overwhelmingly obvious. There's still very compelling price plans for consumers out there in the market on cell phones. So we don't own Rogers. Our preference within the telecom space is TELUS. We just think it's got a better business and better assets. And a stronger balance sheet as well, and is diversifying into other sort of unrelated areas in different ways, which creates some interesting optionality to spin out assets and surface some of the parts valuation discounts and that sort of thing. However, that said, Rogers has some interesting optionality of its own, having fully consolidated Maple Leaf Sports and Entertainment. Having bought out the BCE stake. And, I think you scratch your head when you try and put a value on a sports franchise. But, we saw the LA Lakers trade for $10 billion last week. And, there's no financial model or anything that we would have learned in business school or doing our CFA designations that would justify that sort of valuation. But once you reconcile yourself to the fact that sports franchises are collectibles like racehorses, wine, or art, you realize that beauty's in the eye of the beholder. And so we see precedents out there in publicly traded entities for sports franchises trading at 40 or 50 times enterprise value to EBITDA. So Rogers, to the extent that, eventually the game plan is to do an IPO or somehow surface the value of Maple Leaf Sports and Entertainment, could be interesting. But for the meantime, we're taking the more conservative tack, and we think we'll get better dividend growth, which is the core of our mandate in the Dividend Growers Fund that I lead. And that's why we own TELUS. We think it's just got a better balance sheet and a better line of sight to sustaining its current dividend and growing it predictably over the coming years.
Got it. Okay, Phoebe, I hope that helped you out. We're going to move on to Ron with a question. He's in Calgary today. Hi, Ron.
Yes, hi. I'm calling about NextGen Energy. They have their Arrow project, but they also found a new deposit 3.75 kilometers away that they figured was quite promising. And I just wanted to get your idea of what you think about the stock.
Okay, thank you for the question. We'll have a look here at NextGen Energy. Do you own NextGen? Have you ever owned it?
No, we don't. And thank you for the question, Ron. We actually own the shares of PepsiCo, which is a producing uranium miner. So hopefully that helps answer part of the question. Do we like uranium? Yes, unambiguously. The world needs more uranium. Canada has lots of it, and NextGen is sitting on the world's largest undeveloped deposit of uranium. The world particularly needs uranium from geopolitically stable countries of origin. Much of the world's uranium comes from Russia and Kazakhstan, which are not exactly poster children for geopolitical stability. So we think this will get developed, but it's not producing, and so it doesn't fit our risk appetite. But for more risk-seeking investors, it's probably an interesting trade.
Got it. Okay, we are going to leave it there for questions, phone calls, and emails, but Brian will share new topics when we come back. Welcome back. Time now to take a look at Brian Mannon's new top picks. We start with Tourmaline Oil on the TSX. Pretty well-known name. What do you like about Tourmaline moving forward?
Well, Marilla, contrary to what the name might suggest, is not really an oil producer. It's Canada's largest natural gas producer, and it produces about 13% of all the natural gas produced in Canada, mostly from the Alberta Deep Basin and the Montney Basin in British Columbia. It's got the largest reserves of natural gas in Canada. And we really like the capital discipline here and the lean operating efficiency. They take a manufacturing type of approach to producing their reserves, so optimizing their drilling and completion techniques to lower their operating costs, owning and controlling a lot of their own infrastructure, the midstream gas plants, either directly or via their 21% stake in Topaz Energy. Also, crucially, they were early movers in securing market access at delivery hubs in BC, in California and Washington, down on the LNG export access points on the Gulf Coast, but crucially away from the AECO delivery hub in Alberta, which has some of the lowest realized pricing in the world. So they're consistently able to realize higher pricing than their peers operating in the Western Canadian Sedimentary Basin. What we think is going to be a great catalyst for the whole Canadian natural gas sector is the initial cargo shipping from LNG Canada, and that's supposed to happen, I think, as soon as this weekend. So this plant in Kitimat, BC, $40 billion investment, the largest foreign investment of any sort in Canadian history, 10 plus years in the making. And we think, Marilla, this really has the potential to meaningfully shift the supply-demand balance in Western Canadian nat gas, because it's going to introduce incremental Asian demand for 2 billion cubic feet a day of offtake in a local market that produces 19 billion cubic feet a day. So it's very meaningful. Beyond that, Tourmaline's very cash generative, even at current nat gas pricing, which is very low, and is quite disciplined about returning capital to shareholders via either regular dividends, currently about 50 cents per quarter, and variable special dividends. Notably, the company paid a cumulative $15 in dividends over 2022 and 23 when gas prices were higher. So a lot of potential here, we think.
Let's get to JP Morgan Chase, very well-known company. You guys, I guess, have owned them for a while, right?
No, so this is quite new. We bought this early in June, around $260, give or take. It's headquartered in New York, but of course it is global in scale. It's the world's largest private sector bank. We think it's quite possibly the best bank in the world with its domestic and global peer-leading net interest margins and efficiency ratios. Its number one market share in domestic deposits and credit card transactions. Its number one market share in investment banking, equity, and debt fee pools and secondary securities trading. And then securities transaction and services revenue. There's also a smaller wealth and asset management business, which is a focus for growth for them through a series of strategies and tactics. And really the big picture is banking increasingly is a scale advantage business. And so there is a secular shift in market share away from the many community and regional banks in the United States towards the money center banks, JP Morgan being the largest. So that's an ongoing competitive advantage for them. It's got abundant organic growth opportunities, and as such, it pays out a modest 25% of its earnings. So that's in contrast to the Canadian banks, that typically pay out about half their earnings, and as such, the yield is a lower 2% versus something more typical in Canadian banks of 4%. Okay. And the proof's in the pudding here, of course. Rare is the U.S. bank that can outperform the Canadian Big Six, but JP Morgan has done exactly that with robust earnings and dividend growth, compounding at about 13% over the last decade. So quite possibly the best bank in the world and one we're proud to own. Okay, I've only got about a minute left, so let's get to Costco, which is your third pick. Yeah, so this, of course, needs no introduction. It's the third largest retailer in the world, ubiquitous pioneering presence in warehouse club retailing. The growth algorithm here is driven by a steady cadence of new store expansion. They operate 900 of these warehouses around the world, serving about 80 million members. They get good traffic, and the assortment is narrow. About 4,000 products are stocked in each store, typically branded merchandise and Kirkland or their private label offering. And that's all rolled up to about a 9% compounded rate of sales growth over the last decade. Earnings have grown somewhat faster at about 13%. The shares themselves, since the initial public offering in 1985, have compounded at 17.5%. So it's just become a gigantic behemoth. It almost always looks expensive relative to its peers, but we think that is a reflection of its enduring, sustainable competitive advantage. So any day that ends in Y is a good day to buy Costco. But okay, we do have to leave it there. Brian Madden, thanks for coming in. My pleasure. We'll see you again soon. And that does it for Market Call. We'll see you again tomorrow. A quick look at the markets as we head to a break.